EMs, have we found that line in the sand when it comes to equities as well as the currencies?
Good morning. Well, I certainly think there's a case for still looking at emerging markets more closely, even if it's on a differentiated basis. Absolutely, we could see the numbers in terms of China economic data start to improve as some of those targeted stimulus measures do enter the fray, and the market will look at that positively, but more neutral overall because there are those risks around whether the US dollar will depreciate further. We still have a lot of central bank tightening to come through in some of those current account deficit countries, which could dampen down domestic demand, and then there's also the scope for the oil price to move higher, again impinging on some of those current account deficit countries and hurting consumption overall. So right now it's more of a balanced view on emerging markets, but at today's valuations I'd say there's definitely side for upside to growth in EM assets over DM assets, more so given the relative valuation argument.
Yeah, we've been talking about this JP Morgan report that came out over the weekend. I know your colleague John Norman wrote it, but it was interesting what he said. It was that part of that China stimulus that's coming through is a weaker currency, and that's where it's going to have ripple effects on not just the FX markets, but also equity markets as well. So do you think that this policy support at the end of the day could actually spark the opposite effect?
Well, I think the change in the currency is going to matter most for Asian economies. If the Chinese yuan's lower, obviously that's very bad competitiveness for the rest of the Asian economies, and obviously C's then have to try and think about their currencies going lower at a time when many of them are trying to defend them and actually tightening rates to hold them up. So it does become a bit of a dichotomy. I think that the stimulus measures from China are more viewed as a positive sentiment to saying the growth story in China won't roll over as it tries to offset a lot of these trade negatives. However, it is about that depreciation being more palatable in terms of the smaller depreciation in the yuan that does come through as China looks to that to try and offset some of those trade measures. But a significant depreciation in the currency would obviously be very negative. That's not our base case, and I believe that's what the investment bank were writing about in that report, that we will likely see that depreciation to offset those trade measures, and it does create additional concerns about EM assets. However, it just again highlights that need to be a bit more differentiated when we think about the areas of opportunity within emerging markets, whether it be by country or by sector. And I still think for a long-term investor at these valuations, there are scope there. It's just that I expect that volatility to be higher while we have that uncertainty around the US-China trade agreement, while we have that uncertainty around the oil price and how much it can move higher in the near term. And that's not quite palatable for many investors right now.
You're overweight US stocks and say that they're shock-proof, but at the same time, we're seeing this very narrow bull market, whether it's here in the US or in developed economies. Is this a risk?
We don't think so. If we look at earnings, I would actually argue that the earnings story is much broader this year than it has been historically. I mean, a lot of people talk about tech just being the sole driver. It's actually not. I mean, the biggest driver of earnings this year is actually going to be financials. So, you've had 25% earnings growth in the US. The market's only up 10. So valuations have come down quite a lot. I think that gives you a little bit of support here. And we also think this US earnings story just continues to extend here. We had 20% capex growth last quarter. That's going to really drive top-line revenues in the US for a while to come.
Not surprisingly, they've outperformed emerging markets, but I understand that you've just changed your call on emerging markets from neutral to overweight. Why?
So I think EM is sort of the opportunity here, sort of the other side of that barbell. EM's obviously underperformed a lot. I think there's been a bit of capitulation.
Good morning, everyone, and welcome to today's Trading the European Open Live here at the Live Trade Room. Now, today is Tuesday, the 2nd of October. We're 2 days into the final quarter of the trading year. So just to give you a brief background, we're technical traders and we really focus on what price is doing. So what we look to do is to identify high probability opportunities in these markets, and we'll look at some of the most liquid global markets out there, ranging from foreign exchange through to commodities and also through to equity indexes as well. So we trade a variety of different asset classes, and we look to execute trades and manage those trades with a certain degree of discipline and consistency in our approach, and discipline with regards to our capital. Protecting our capital at all times is our primary concern, with a view to cut our losers short as quickly as we need to, but looking to let our winners run, which is effectively how we trade these financial markets, and all with one view, and that's to book in consistent returns over the medium and longer term. So without further ado, we do have some very, very interesting setups now this morning. So please do familiarize yourself with our risk warning currently up on screen. I'll just post a brief comment into your chat box. So do feel free to post any comments or trade ideas, perhaps even, into your chat box, and we can see those come through here on our side. So before we begin, let's conduct a very quick review of potential market moving news, and for this we'll bring up Forex Factory. And as we look through the trading week, it's just useful to know that there's a bank holiday in China for the majority of the week, in observance of National Day. So as we look through, we've had a rate decision made by the RBA to keep rates at 1.5%. So we'll have a look at the Aussie dollar now very, very shortly. And as we flick through, you can see we don't have a huge amount of really important data being released. We've got a lot of geopolitical, more global issues to concern ourselves with that are impacting these markets adversely. But right now, in terms of a news flow, we don't really have an awful lot to contend with. We do have the Fed chair, Powell, due to speak about the outlook for employment and inflation at the National Association for Business Economics annual meeting. So that anytime a central banker is due to speak publicly, the markets are listening very carefully for any information about their approach to interest rates. Okay, so that's our news flow in terms of scheduled news events. What we need to be cognizant of now is the more macroeconomic events. There's concerns in Europe regarding the fiscal position of Italy. That's weighing heavy on the euro right now. And Euro has other sort of structural issues as well that it needs to contend with, and of course their involvement with the Brexit negotiations as well. It'd be interesting to see how these things play out, but what they do is impact these markets quite considerably, obviously largely with regards to the euro. In addition to that, we've had Trump as well, basically hype up the whole trade war situation with China as negotiations are underway. There's a lot of commentary being played out basically through the press, and it's clearly going to weigh heavy somewhat, the whole sort of the way in which these negotiations are being dealt with. So we'll see what that means for the markets now very shortly. So as well as scheduled events, which are obviously important, there's obviously more geopolitical, more macro events for us to concern ourselves with as well. Okay, so without further ado, let's bring up the charts. We've had our move now in the euro dollar over the Asian session. We've had a fairly straightforward flush down to this lower level, the 1724. I just want to draw your attention to that level. It has been a significant and a very important level. We were talking last night during our capital growth webinar that we're very likely to get continuation down to this level, but it's how price behaves at this slightly lower level is what would be really quite interesting for us. And if we get a break below that level, we'd be looking to see some continuation in the euro dollar. We would expect it to happen. We do want to see the price follow through with regards to that as a trade idea. So we absolutely will come back to this market and look at this in a lot more detail. Okay, so, and you can see the move there. It's basically 1, 2, sort of 3 hours ago. We saw that really strong flush lower. The pound dollar, this is now primed at a level that we do like the opportunity to sell the pound dollar. Those of you that were able to access our daily trade watch video last night, we've identified the pound dollar to the downside below the 130 level, and also the Aussie below the 7200, and you can see we're just below those two levels as we speak. So we're definitely going to go in and look for those opportunities. Dollar yen just pulling back off its highs, so we'll skip through this. The dollar Swiss not doing an awful lot. A bit of dollar strength coming back into the yen and the CAD after yesterday's strong devaluation to the downside. The Aussie dollar, I'm going to take note of this relatively swiftly because we're going to see if we can get into this market. New Zealand dollar is in the same boat as the Aussie dollar, so we'd probably look to either trade one or the other. Moving along fairly swiftly because we'll build this this morning's trade plan very, very shortly. The euro pound, potential continued strength in the pound against the euro. We're currently trading at these lower levels, but definitely better opportunities in the pipeline. A market that would be interesting for us, showing us a structural failure, would be the pound yen. If some strength continues to come into the yen, you might get an opportunity to sell it below the 147.53. But again, we've got bigger fish to fry, let's say. Same situation, a nice strong reversal, and we're now below the weekly low of 131.16. Again, we've got better opportunities in other markets. Gold market, just we get a selling day, we get a bit of buying coming in. Yesterday it was a little bit bearish, now today it's bullish. We also like the potential for the US markets to just tick over to the downside. So what we're seeing from a technical perspective with this market is the potential for a structural failure, and that's when we get the market making a high, bouncing off, creating a very clearly defined floor around the 2900 level, and we attempt to make a new high, and of course we get a failure. So this is potentially the start of a reversal, and trading below yesterday's low with a bit of momentum and a bit of sentiment regarding the sentiment, or should I say the negotiations with regards to the global trade war with China and the impacts that could have, may start to weigh a little bit heavy with all the political wranglings that are going on the S&P. So we still perceive these markets to continue higher. We might just get a short-term move to the downside, and today looks like the day in which we could see that move. So we do want to add this to our checklist for continuation to the downside. So we use multi-time frame analysis to allow us to navigate. Same for these US equities. This is another potential example. We will focus on the S&P and the FTSE. We're likely to see the pound dollar move to the downside. So actually we do like this market lower, but maybe our focus should be on the pound dollar instead. And we also like the Euro stocks lower as well. So we can add this to our understanding. We're not too far away from that level, and so we've got quite a mixed bag. In fact, the dollar and perhaps the equities is where we could get most of our kind of moves. So what we'll do first of all, we'll just create our trading plan. So we've got 1, 2, 3, 4, 5, 6, I believe. So we'll have a straightforward, we'll have a 6 market screen for us to focus on. So we'll put the euro dollar, in fact we want to put the pound dollar in here as well. That's very important for us. So just give me a few seconds while I just organize our trading screen. So we'll keep an eye on these 3 markets here. They're all 15-minute time frames. So we're going to be looking for continuation to the downside in the euro dollar, the pound dollar, and the Aussie dollar. The New Zealand is in very much the same boat as the Aussie, so I think we'll just track. We'll just put it over here, but we'll focus our attentions on the Aussie dollar, and we can refer to the New Zealand if we need to. Now, outside of the US dollar, we've also got a couple of opportunities. Firstly, we can place the S&P market, and we're looking at it in a 15-minute time frame, and we're getting a constructive pullback now in this market. So we'll come back to this in a second, have a look. And the Euro stocks. So so now we're getting a little bit of a pullback in both of these markets. Excuse me. So this is our trade plan for the session. We're going to look for dollar strength to the downside, and we're going to look for the potential for the S&P to tick over. Although we are cognizant of the fact that US equities are performing particularly well. I mean, everyone knows that the US equities are in a very strong bull trend. So what it really is more of a short-term sentiment-related trade off the back of tough negotiations with China and the impact that could have on the US equity markets. So that's the Aussie dollar, the pound dollar, the euro dollar. So let's go into each of these, and we'll create our actual trade plan in terms of the levels we'll be looking at. So you can see we've had a really strong continuation to the downside. The 1524 is actually quite an important level. Now we've got a couple of options. We've had a really strong move in this market already, below the weekly low. So if this market comes back to the 1563 level, and we're currently at 1535, then it could give us the opportunity to sell it at a much higher price. If we were trading this market, we would have really liked the breakout, this little breakout candlestick here with the expectation for continuation, but obviously that was about 2 or 3 hours ago. We obviously, the market has moved lower. It has effectively bounced off the 1524, so these few pips here don't really mean an awful lot with the size of this market. So we are currently experiencing our bounce back off that level. So we do want to watch it quite closely. We've got a couple of options available to us. If I just get up our pen, if a floor is created at this level, so we get a bit of this price action, then if it creates a clearly defined floor and we get a breakout of this level, we'd expect it lower, and then hopefully it'll be creating a high here for us to place our stop loss. So that's the first thing that we'd like to see. Secondly, what we would like to see is just a very straightforward kind of pullback off this level, and if we get that, then we'd be looking to sell it from a much higher price. So we've actually got two options. This is the pullback trade, and we've also got the breakout trade, potentially below a bit of a floor, and we'll capitalize on that pullback. Sorry, on the breakout. So we've kind of just got to watch this level, because we do know, we trade the markets technically, and we can look back and see how prices behaved at that 15.24, and it's quite significant. It's not something that us as traders, especially technical traders, should ignore. So it is an important level, and really it doesn't really make sense to sort of get into it at this 15.35 because of the strong level below it. So we need a strong pullback, or we need a floor and a breakout. So we'll have to keep both options open there for the short term. Right, we quite like the pound dollar. Just looking at it again, so we've just got this break of the last 2 days. We've just got this little breakout to the downside here. We've got a nice little bit of market beneath these prices, so we'd expect continuation. And all we're simply looking to do is looking for a good opportunity to get in to this market. So let's look at it at this level. So if we're looking to sell it, what we could do is look to capitalize on the breakout below the 29.89 level, and we could probably place our stop loss just above the 130 level. So if this market creates a bit of a floor and we get a break and flush to the downside, then we'll look to stay in this market to the downside. And it might still pull back an extra couple of pips to the upside. So we could look for a breakout trade in the pound dollar with the expectation for this market to move lower, so we can firmly identify that as a strong level to focus on with the pound dollar. So we're looking at the 29.89 to see if we can capitalize on this market to the downside. I just want to sort of draw a line there, because that's the all-important level for us. So that's the level that is really of interest to us. So let's allow these markets to just do what they're going to do right now. We do like them lower. And let's see if we get that move or not. So again, we've got our weekly low, which is 7,200. We are below that level. Just currently experiencing a little bit of a pullback. So what level would we like this market to pull back? It's clearly the 71.94, and we're just at that level now. So that creates quite a nice high for us if this market continues lower, the 85. So we're only sort of 5 or 6 pips just above this low. So what it does is it gives us a clearly defined range for a breakout with a 10 pip stop loss. So again, we might look to take a couple of breakout trades. We know we want to be trading these markets to the downside, and so we can look for a nice consistent breakout beneath this low, and then place a stop loss above these highs, maybe even above the daily high as well. As soon as this market ticks below the 15.24, we'll be looking to get into this market as well. We do need a structure like we're seeing here, so we're just slowly getting that little breakout as we speak. So what we want to do is just see a close in this market at that price. So there's our close. Let's get a tick lower, and then we look to sell this market. So if we get continuation So this is why we wait for the extra tick lower, just in case we get a little bit of a pullback creeping into the market. Okay, actually getting, well, a stronger pullback that we would like. So let's have a look at this on a 5-minute chart. Bit of a floor being created there. So now let's see if we get that little flush lower or not, whatever the case may be. I just want to have a quick look here. So it's looking closely at that daily low, isn't it? So let's have a look. So we've got the break above that level. It looks like we're closing on that level, or closing below that level, should I say, on the 15-minute time frame. So again, we're just straddling this daily low in here. So what we can do is, clearly it's got some decision making to perform around this 29.17 level. So it wouldn't be a bad idea to see the price break below the 29.16 level, and then we could place a stop loss just above the 29.19 level. So potentially a couple of markets to keep a close eye on. And the Euro stocks. So now we've just literally bounced off the weekly low, which is the 33.17 or 33.77, I think it is. But we need this market to break below. So only at that point are we consistently looking for an opportunity to sell this market. So selling above support is something that we don't like to get involved in, unless there's like a strong structural failure at a higher price that gives us a nice move lower, kind of like we've seen, but really it's a little bit messy at these levels. So we gap to the upside, we've moved this way, and then we've rolled over. So we want to see some continuation to the downside. We can continue to look at this market on the 15-minute. So hopefully we'll get some nice moves in these markets today, or we'll get continuation in the dollar. Hopefully we will get some follow through. So the pound dollar now is breaking lower, it's pulling back, and it's just, at the moment, it's reluctant to break this new low. So this is now marginally the new level that we're now interested in, which is just below. Okay, so there we go. So we still expect, obviously, this market to flush down. In fact, we do across the board. But I suppose this is one way in which we can practice our timing and our entries. I hope you would agree. we have a strong conviction for what we want to happen. We're trading a bit of dollar strength. No major surprise by that based on previous price action over the last few days, certainly since Wednesday night. We're following through with that sort of idea and sentiment behind that market. And now we're just applying a methodology that allows us to get in and out with a certain degree of objectivity. So what we're saying is if we don't break these two levels down here and we don't break the 1524, then unfortunately we'll have to step back a little bit. But hopefully during the session, and this is why we trade the first few hours of each open, i.e. the European Open at 8 AM and also the US Open at 1 PM UK time. So those times are normally, I mean, we've been collectively trading the markets for over 40 years between us here at the Live Trade Room, and we've always intraday, we've always traded the markets on an intraday basis during those more liquid times. Something that was quite evident really over the last month, and it's a bit peculiar, but we often saw a lot of what I call later session reversals or moves during the latter part of the trading day, which is obviously, it's not optimum, but you still want to be trading the most liquid part of the trading day, and that's when the volume starts to enter these markets. And ordinarily you get follow through. We can suggest, and we know this from our trading behaviors over the last few weeks, is that we never really fully saw the follow through that we would have expected across many markets. And our approach to trading these markets always remains the same. If the price doesn't perform as we would expect it, that is your first signal to either reduce risk, don't tolerate any losses, be a lot more suspicious of these markets, create a bit of indecision, and if in doubt, effectively stay out and wait for those higher probability trades to arrive. And all of these trades, they're all high probability trades to the downside. They're just not moving just yet. So we're now focusing on our timing, the execution part of trading these markets. And these pullbacks, what they do is create levels and highs that we can utilize for our stop loss. So they could effectively make our stop loss a little bit smaller, a little bit neater, which is obviously would be a good thing if you can get into trades and keep those stop losses on the smaller side. So we're not getting the follow through just yet in the S&P 500, and actually a break above the 29.19 is effectively a structural failure back to the upside. So it allows us to back off under certain situations. And the Euro stock is just struggling to break below the 33.77. So all of these markets are just pulling back right now. That's all they're doing. Nothing of any major concern just yet. If we get a break above 29.19, we might see how price acts above it, but we might take that off our list. And the Euro stock is really struggling to break below that 33.17. So only if that's the case are we interested in getting into it. So we've got a clearly defined plan for trading these markets. So I'll just put our trade plan up here. This is the level that we're looking for to see if we get that little break to the downside. With the S&P, we're looking at the 29.16 to the downside. And finally, if I just shift it across a little bit, we're looking for a break below the 33.77. So that's our trade plan. We just need to obviously just be a little bit patient now. We really strongly like these markets to the downside. Good morning, guys. Hello, J4FX Diamond. Good to have you back with us again. So you want to ask that sometime trend is bullish toward the last time consolidation zone. Should we go long or wait for passage of consolidation zone? Well, the first thing is, can you, and in fact you've kind of answered it really in the statement that you've made, can we have an understanding of the market conditions? Certainly since Wednesday night, if we talk about trading the dollar, we're in a bit of a dollar bull trend, only over a few trading days. So that's the first thing. And what are the market conditions? And actually they're quite bullish. The second thing, which is what you've alluded to, is the direction. Should we go long or should we wait for a passage of consolidation zone, right? So we do have the market conditions and the direction of bias. So we're in a trending phase of the market and we are looking to buy. So that's the two first very important parts that you should be able to identify before getting into any trade. Now, then the next stage, as you can see up on screen, stage 2 is about the execution, and that's really what you're asking for. How do we execute trades in these markets? Let's take the pound dollar. Our decision making is quite simple. We've got a weekly low at the 130 level, so we know it's an important level in this market, and it's a psychologically important level as well. 130, all the big numbers are psychologically quite important, and we're currently below that level. So the dollar's trending, and we want to, as a result of the pound dollar, we want to support the US dollar, which means we're looking for this market to move lower. So once we've made that decision, we then need to focus on our execution, which is effectively what you're asking. And yes, you've got two options. You've literally got wait for consolidation, which creates a bit of a floor in the market. It's something we were discussing regarding the euro dollar. We want to see price move sideways, which is consolidation. And if we get a breakout of consolidation, we're happy to sell it. Now, in addition to that, we also, in fact, let me get up the US dollar so you can, or the euro dollar. So in addition to that, we can see markets just consolidating at this level. And if we confirm what you're suggesting, and I'll take all of these off. So to answer your question, if this market performs like this and just continues to move sideways, and you can look at this market and go, actually, this now is consolidation. You've got two options. You can obviously sell, because we're looking to sell it. You can either sell the high in here, or you could sell the breakout. So with each session or each decision has pros and cons. If you enter it at this one here at number 1, or should I call it A? If you enter at A and we have a breakout trade at B, then you have a really small stop loss potentially with A, and you might have a much bigger stop loss with your B trade, which is your breakout trade to the downside. So both have pros and cons. So you need to weigh that up. But so should we go long or wait for passage of a consolidation? What we would never look to do is to just randomly sell a kind of a random price with the expectation for this market to push lower. So we'd be looking at this price action and we'd wait for some confirmation for us to take this market lower, and that could just be as simple as identifying a low. So if I take these two levels in here, so we can see that the market's flushing lower, we can see that we want to sell it, and the market creates a low, so therefore we identify these little breakout little levels. We could either trade the pullback, or we could trade the breakout. Now this is on a 1 minute time frame, so this isn't optimum, but we can see that this market moves sideways and respects the level. We could buy the pullback, sell the pullback, or we could sell the breakout to the downside. Either way, they don't always have to be profitable trades, but if you get in at this breakout, you'd have a stop loss in here and you'd still be in this trade probably now. Well, maybe not. Maybe you might take profit at these levels. So this is what we wait for. We wait for either a low to be created, and we can trade a pullback, or we can sort of wait for a floor to be created and then trade the breakout. Yeah, absolutely. And momentum forms a huge part of that. And what we can see from this market is there is momentum in here. The bigger candlesticks in this example, although there's not a huge amount of them, but the big candlesticks in this move are all red candlesticks, or most of them. There's a few sort of positive green ones in there, but you can see the momentum physically with your eyes, and you can see that these markets, the stronger candles, are very much to the downside. So we're trading a market, we're trading a US dollar bull market to the downside. We've identified the actual symbol that we're looking to trade, which is euro dollar. The euro dollar has its own issues. So again, what we're doing is we're getting the technicals. We're having an understanding of that. We clearly have a bit of fundamental sort of developments which are supporting our idea to the downside, and our sentiment as well. There is a bit of sort of bearish sentiment behind the euro dollar. So we're getting all of these market conditions, which means your trading opportunities are very much to the downside. And now it just becomes a discussion about execution, and the more consistent you are with that execution, we would regard the more money you'll effectively make trading. But it is a skill, I guess, and it's like any skill. It's like learning any particular skill of any kind. It requires a lot of understanding and knowledge, and a lot of consistency, and a bit of practice, and a bit of time spent executing similar trades on a regular basis. And all of that formulates your experience. And then if you add in a really strong approach to risk management, where you make sure that you don't take big losses when you trade these markets, then all of a sudden you're building a really reliable and kind of trustworthy approach to these markets, where you're identifying high probability trades, you're executing and managing those trades with a high degree of consistency. You're looking for those same opportunities time after time after time. You've got a really strong approach to risk management, which means you don't take significant losses on your account. We're comfortable taking small losses, because when we get our analysis right, we can let our winners run and make a nice return on those trades. I think before last Wednesday's news announcement by the FOMC, I think we had something like 7 or 8 back-to-back losing trades, and of course that's not what we aim to do, but we also knew that the market was very choppy, and the reasons why those losing trades are not really a concern is because they were really small in terms of pip exposure. Some of them were even half the normal smallest trade size that we take because of the market conditions. So actually our monetary exposure was very, very small. And then we were able to capitalize on 2 big solid trades. And we even took those 2 same trades on a couple of other occasions, and we only just got grazed out of each of them. So unfortunately we took a couple of smaller losses again, and on another day that would have probably looked to have doubled our potential returns. So we comfortably in 2 trades, we got literally a multiple of our exposure off those 9 trades previously, 7 or 8 trades previously. So that's the nature of trading. And the psychology of losing is very important for traders, and also the psychology of winning is also very important. Under no circumstances will you see us, if we have 5, 6, 7 back-to-back winning trades, will we start changing our approach. It remains the same whether we win or whether we lose. And what we know is market conditions change in the ebb and flow. So we wanted to take that on board. Some market conditions really favour our approach and others don't. But what we're not going to do is chopping and changing. We're going to just make some decisions regarding our exposure as these market conditions change. So sometimes resistance line is upper and lower trend line is intersecting it. Price is stuck between it. Yes. Yeah, so if price is stuck in the middle, then I think you're actually technically talking about a consolidated market. And why we like consolidation is very, very simple. The direction in which the market moves previously is actually really quite important. But if you get this kind of price action, we can firmly say that there is the move that came before it's to the downside, so there might be some expected continuation to the downside. You might have a little bit of price pressure coming in here, pushing these prices lower. And then under circumstances like this, a breakout trade would become your high probability trade if you get that confirmation that you're looking for. And you might get continuation to the downside, which means you might take on a little bit more risk. You might place your stop loss above this level up here, and it's behaving in a very consistent manner. So if you trade this kind of setup 10 times in a row, you may take 3, 4 or even 5 losing trades on this, potentially, depending on the stats, but your winning trades will be a significant multiple of anything that you may potentially lose in these trades. So either way, you're looking to stack the odds in your favor. So if you took a 1% losing trade and you took 5 losing trades, that's obviously a 5% loss, but you're likely to get between a 3 and maybe 10 times your risk in these markets. So you could see a 3% return, or a 5%, or 7 or 10, whatever the case may be, because we look to let our winners run. Then obviously that stacks things in your favors to an incredible extent. So yeah, I hope that makes sense. If I have answered your questions correctly, I think I probably have, but do let me know. Do let me know if I haven't. So we're getting this uncomfortable, kind of fairly strong pullback now. Which is not great. We're obviously still expecting this market to continue lower, and we're just getting a strong pullback in all of these. Well, not a strong pullback, but a pullback. I must choose my words very, very carefully. Yeah. Here's a personal one. What was the biggest loss in your entire trading journey? Great question. I've actually got 2 of them. And I suppose they're similar in certain situations. I'm sure you all remember the Boston bomb. Now, that rocked the markets. Now, trading my own capital at that point, I can't remember if I was trading the yen or the dollar. I can't remember, but I had a number of trades which I built positions for probably 2 months. Was in about 8 or 9 grand of profit going into the Boston bomb, and that really shook and rocked all of my trades, and they started to pull back. So I spent 2 months trading, building these positions, was in a great position. What I didn't do at that point was book in profit as the market is moving in favor. So what effectively I did, I think I broke even on most of those trades, even though the price was really, really far away from the levels that I was trading. But I saw effectively within 12 hours, I saw, I think, about an 8 grand devaluation. Now, you talk about loss. It felt like a loss, but actually what I've done is I made sure, I think I took a very, very small profit out of those trades that I built for two whole months. And that was with the amount of capital that I was currently trading with. And it was because of my approach to risk management wasn't as effective as it is now. And the other situation, which was a little bit, again, it's very fundamentally driven, which was Cyprus going bankrupt, and how that shook the markets, and specifically some of the trades that I was in as well. Now I built up, I think again it was a 5 or 6 grand sort of position in a number of markets, and Cyprus sort of hit the rocks, and that shook a lot of the trades, and I think I took a 1 grand loss after. So there was, in terms of a deficit, I think the Cyprus situation was about 6 or 7 grand, and comfortably the Boston bomb was about 8 grand in terms of losses in a very, very short period of time. So you'd think I would have learnt from the first situation. I can't quite remember which one was first. Maybe it was the Boston bomb. I can't remember which way around it is. But I didn't really ultimately learn. You know, I was still able to get into trades, build positions, make a significant return on them, and unfortunately, you know, gave it all back. And I'm pretty certain it was the Cyprus bankruptcy that actually cost me money, having built positions again over the course of a few weeks. So yeah, those are the 2 events that really do spring to mind. Another major event was the Euro Swiss. Now I wasn't actually trading it at the time, but I do remember 9 p.m. and sorry about this, guys, like if we're looking at these markets and they're not really moving in the direction in which we were looking to trade them. I'm looking closely at the 71.85 in the Aussie dollar to the downside. But I'll show you the Euro Swiss chart. The 15th of January, 15th of January. It was 9 a.m. 15th of January 2005. It's a date I kind of won't forget. Oops. Let's place this template, and I'll take you there now. This move here. So what we had was kind of a really strong, it was around the 120 level. So the Swiss central bank was supporting prices, and it was costing the Swiss central bank too much. Prices were pushing to the upside, and loads of traders. What was going on here from a psychological perspective is there was a build-up of stop losses underneath this level, because the Swiss central bank kept buying this low at these levels with varying different degrees, and it goes back a lot further as well, and even fairly recently there was lots of buying coming in. So traders thought it was a no-brainer trade. I know a number of traders that got caught in this, but there was a build-up of stop orders, and if price breaks that 120 barrier, then all of these stop loss orders become sell orders effectively. Plus there was a high degree of sell trades, stop orders at that level as well. And what we saw in the space of 15 minutes was a move from 120 exactly down to 0.85 down to this, and that was probably a 15-minute devaluation. And it was at 9 a.m. the Swiss central bank made a statement to the market saying they're no longer going to peg the Swiss franc against the euro at the 120 level, that they were going to remove the peg, and markets started to flush through at a very quick. And I was looking at prices around these levels, and I thought there was a world war had started or something major had gone on, and I was seeing a lot of my charts just showing like major losses. And I'd only left the desk literally probably 1 minute to 9, and I probably got back at 1 minute past 9, and this market had devalued sort of 40% in 50 minutes. And I was wondering what in God's name had happened, and it was very difficult trading conditions, but it was because the Swiss central bank removed the peg, and because of the technical, what was going on technically in these markets was such that there was an immense number of sell stop orders and stop losses below this level, and all it did was really drive with incredible momentum price action to the downside. And there's a few, if you look into this event, a few brokerages went under as a result of a 15-minute collapse, and that just shows the precariousness of some of these events. And if a brokerage was unable to manage this process properly and to take risk into account. Now, the good thing is the regulation has improved considerably over the years, so it's less of a significant concern now. But certainly 2015, with the regulation that existed, it was, there was a few brokerages that really paid the price. I know FXCM, I think, took a £300 million hit in about 15 minutes. So I think they either sought some rescue finance or they were kind of taken over in some capacity or whatever. I'm not too sure. But anyway, a lot of these brokerages really paid a big price. Yeah, my pleasure. So you had 6 losses in a row. The psychology of loss is a really important skill to develop. I suppose you can do it in 2 ways. You can either learn yourself, or you could learn from perhaps the mistakes of what I've made, and certainly the other traders here at the LiveTradeRoom, what we've all made. And that's why when we say, it sounds boring to talk about consistency and discipline, and when we talk about discipline, we're only talking about discipline with regards to your capital. We're not talking about any other form of discipline really. So it's not in disciplined kind of organization or getting to your desk at a certain time. We're not talking about that kind of discipline. It's largely focused on your capital, how much capital you have available, what percentage of your risk of your capital do you expose in these markets. Generally, when you're starting out, keep that lower. You can always increase it when you become a bit more experienced. And certainly we do identify on our own trading accounts, we do identify, larger percentage no-brainer trades. We haven't really been trading an awful lot of them over the last sort of month or two. Certainly over the summer months, we wouldn't do that anyway. But sort of April to June was pretty good trading conditions, and we're able to really benefit during those market conditions. And then you go into the summer, so you back off a little bit, and September felt a little bit summery. It felt like we weren't really getting the follow-throughs that we would have anticipated or expected. So yeah, needing some motivation. So really the only thing is focus on the psychology of losing. Try and keep an even keel, even if you're taking those losses. You know, and keep those losses low, especially during difficult market conditions. Like, I can't remember. I don't know who we have online currently, but you know, the question's been floated a few times. You know, why don't we increase our stop losses, or why don't we give markets a bit more room? A very, very valid question, and the reason being is we're not fans. We don't really like the market conditions. They're too turbulent. They're not really following through in a way in which we expect it. Now, and that was over a good 3 or 4 week period. So please don't feel that there's anything of major concern if you take 6 losses in a row during these markets. Now, hopefully these markets will start to pick up considerably and really start performing for us. And if they don't, then we're going to exercise a little bit of caution again. So really focus on avoiding taking big losses, because when you do capitalize on those 2 or 3 profitable trades, you can comfortably secure your capital. So take small losses during difficult market conditions and look to let those winners run when you get that opportunity. So hopefully that's what we stand for here. That's the kind of the realistic approach that traders need, and probably the support that traders need. You're absolutely right. You know, traders need motivation, and it can be a very, very lonely environment. And that's why we set up the Live Trade Room, is to provide traders with a sounding board. You'll see us take losses, and you'll see us take winners. You know, the idea is that we see growth over the medium and longer term, and don't put too much pressure on your next trade, because it may be a loser, and you don't want to put all your thoughts and fears and anxieties in a losing trade. It doesn't make you feel good. So keep an even balance, focus on the psychology of trading these markets, have the approach that is consistent with a bit of discipline, and then learn as you go and fine tune perhaps a few minor aspects of your trading approach, and be in the markets long enough to learn how to trade them. That is what the average length of time a person spends trading these markets is about 3 months. I don't know about you, but I don't think you can accomplish any skill at all in 3 months unless it's a really small sort of minor skill and you're spending a lot of time practicing. You definitely need more time in an environment like this, and most traders don't give themselves that opportunity because they're too frivolous. They they will take risks, and then they're kind of gambling, whereas what we look to do is to take is to weigh up these markets and take calculated risks. And that's very different to just gambling, tossing a coin in terms of whether you're buying or whether you're selling. That's not what professional, profitable traders do. Yeah, thanks for sharing your journey losses. Yeah, we don't want to sugarcoat trading. It can be a difficult environment. What we kind of pride ourselves on, I guess, is giving traders the support that they need effectively to stay in these markets, to learn how to trade them. And then once you've learned the skills, it's a skill for life. It's not something you lose after 5 years. You only get better and better at identifying the types of setups that you generally like. So absolutely my pleasure. Thanks for those questions. Listen guys, I do appreciate it's just gone past the hour, so we're going to switch across to the Live Trade Room. I was really hoping for some follow through to the downside, and as you can see, we're just pulling back on these markets. So in fact, all of them, all 5 trades that we're looking at are currently pulling back. So we'll switch across to the Live Trade Room now. We do have our traders there in our own Live Trade Room. So do feel free to join us, guys. You can see the basic information below, and we're still currently offering a 2-week, 14-day free trial, so you can join us without any obligation of any kind, just through that link, and a little bit more information below. So if you do like our style of trading, and perhaps you are sort of interested in that kind of mentorship, then that's what we're here for. That's what we're looking to do. So do read the details before, go to a website, drop us a message if you have any questions of any kind, and you know, hopefully you can gain instant access to the live trade room. So and we do have we trade daily time frames in the evenings, so for those people that can only commit 30 minutes a day, perhaps you're in a full-time role or whatever, or you're studying, or whatever the case may be, there's an opportunity to learn how to trade these markets on a part-time basis for just 30 minutes per day, and that's at 9 o'clock UK time each evening. So so on that note, thank you very much for joining us. Please do subscribe, give our thumbs up to this video if you can, and subscribe to the channel. And you can also connect with us through Facebook, Instagram, Twitter and LinkedIn, and we'll be back again at 1 p.m. to see if these markets can start to move. So from everyone here at the Live Trade Room, thanks very much for joining us. Take care, and we'll speak to you soon. Bye for now.